Welcome to today's Savant Live webinar. We appreciate you taking time out of your day to join us as we discuss family business succession planning after the new normal. Today, we will look at business succession planning and strategies to maximize value and family harmony. You will now see on your screen our agenda for today. First, we will review our broad objectives for the presentation. Our presenters will take us through a discussion focused on transition planning and the income tax considerations when developing a family business succession plan. They will lead us through a better understanding of the role of estate and gift taxes when doing family business succession planning. They will talk through maximizing your potential payout as a business owner, and they will finish up the presentation with post-closing considerations. We will work to allow some time for questions and answers at the end of the presentation. My name is Stephanie Willison, and I am a financial advisor with Savant, located in our Indianapolis, Indiana office. My previous firm, Trayborn Wealth Planners, merged into Savant in August of 2021. That was the execution of our firm founder's succession plan. I am pleased to introduce our presenters today. First, let me introduce Chris Plaguey, Savant's tax growth leader. Chris has been involved in the tax and financial services professions since 1983. Chris has specialized knowledge in income tax planning and preparation, financial reporting and analysis, financial modeling, and general business management consulting. Chris has a key intrinsic belief that the best way to help clients is to really know them. This desire to truly know and understand clients is crucial in family business succession planning. Also joining us is my colleague, Mike Sears, Senior Director of Wealth Transfer. Mike has over 25 years of experience as our attorney concentrating on complex estate and business succession planning matters. He enjoys taking on and accomplishing unique challenges, especially those that involve the integration of multidisciplinary specialists in the legal, tax, and trust arenas. Succession planning for family businesses oftentimes lends itself to multidisciplinary challenges that Mike is experienced in and enjoys. I am really excited to introduce Mike and Chris today as your presenters on this interesting and important topic. Let's get started with our agenda and show you our objectives for our time together. Our goal is to provide some key considerations when contemplating the sale of a closely held business. We will touch upon these concepts at a high level, so it is imperative that you work closely with your legal and tax advisors for more specific recommendations relative to your own unique situation. We will identify some of the planning hurdles business owners now face after the new normal from a tax and an ROI perspective. Let's go ahead and move to the presentation. If you want to communicate a question, use the Q&A icon at the bottom of your screen to do so. We will work to answer as many of your questions as possible at the end of the presentation. Chris will get us started with the agenda item of transition planning. Thanks, Chris.
Well, thank you very much, Stephanie, and welcome to all of our webinar attendees. We're really delighted to have this opportunity to discuss business succession planning with you. And Mike and I have helped many clients over the years sell their businesses. And one thing's for certain, the impact of the COVID pandemic has really refocused timelines, for instance, particularly with baby boomers, on maybe going after a retirement goal sooner rather than later. And so if you're one of those business owners and you're thinking about selling, we want to make sure that we help you think about exit strategies, and all those plans should be well developed in advance of any actual transition. So some of the tools that we can use to construct those strategies would be shareholders agreements. So if you own a corporation, you can build buy-sell provisions within your shareholders agreement. We'll talk about that a little bit more as we go. Employment agreements, you can add severance pay components, deferred compensation components to an employment agreement. what about compensation models? How might the owner's comp change from being an owner, maybe during a transition period, and then post-closing if they're sticking with the business for a while after the sale? And then really business form is very important too. And in particular, the impact of Code Section 1202. We'll talk about this more later, but this I think is one of the coolest things going as far as tax savings in selling a business. It's known as the small business stock gains exclusion. And again, we'll get into this a little bit deeper when we go here. So one of the first considerations the owners have to think about is what exactly is it that you're selling? We often think about selling a business, but what does that mean? And buyers and sellers generally have different objectives. So buyers typically want to buy assets, sellers want to sell stocks. So you could have a stock sale or an asset sale. We'll talk about the difference between the two, particularly from a tax standpoint. Another element to have knowledge of is goodwill. Many small businesses have an asset known as goodwill that may represent the largest and most valuable asset of that business. And the key thing to know is that there's actually potentially a difference between personal goodwill and enterprise goodwill. And how might you use those allocations to your advantage to minimize your tax hit? Again, deferred comp, consulting agreements, severance pay agreements, those are other effective tools for transferring the wealth of a business from a buyer rather, to a seller, as are restrictive covenants and non-compete agreements. And they do have different tax consequences attached to them, which we'll get into as well. Understanding a seller's basis is also critically important. So whether it's a stock sale or whether it's the sale of the assets of the business, knowing what your basis is in your stock or in the assets of the business is very, very important, particularly when you strategize around how best to package a transaction. It's really about how much you keep, not so much what you sell it for. I mean, that's important, but how much you keep after the tax man gets paid is super important. And timeline is a big issue too. Let's allow enough runway to effectively plan for this transition. So moving on here, as we think about other considerations, well, the next one is, well, how do you establish the value for your business? And the main handicap that small, closely held businesses have is that they're not traded on a public exchange. So there's no ready marketplace for your business. And therefore, you have to look at ways to value it effectively and fairly. And there might be benefits, or there definitely are benefits in perhaps adding a built-in formula to some of your documents. So we mentioned earlier, shareholders agreements, employment agreements. In an LLC context, operating agreements. You could actually build buy-sell mechanisms into some of those documents. So thinking through that, how best to arrange that is something you want to do well in advance. Might there be a prescribed methodology to how you come up with a value? So for instance, a multiple of EBITDA is pretty common with many businesses that are bought and sold. Maybe a percentage of gross revenue. What we call look-back calculations. So you take a look at what the owner or owners of the business had pulled out for personal benefit, compensation and benefits over the last 2 or 3 years, and perhaps take a multiple of that. Those are all examples of how you might build a formula into your documents. And then, of course, it's always good to know industry benchmarks, market comparisons. What does your business sell for in similar industries and in similar types of business activities? And then the other thing to think about is, do you actually want to have your value calculated? If there's these built-in formulas or methodologies, might you actually go through that exercise every year or 2 or 3, just to have that knowledge, that running knowledge of what your business is worth? And that may be helpful as you identify potential buyers and we talk through the timeline of when this may all happen. All right, moving on here. So the other consideration is, are there any non-tax issues to be thinking about with a transition? And the answer is definitely yes. So control, first and foremost. And many small business owners might be owned by one or two people, and they have all the controlling interest in the business. So how might that get transferred to the new owners? That may be particularly important when you think about minority owners in a business that might move over to being majority or solo owners. So making sure you get that control transition plan well laid out. Likewise, management. So is the next generation of managers and leaders within the business, are they ready to go? Have you properly prepared them? Particularly if it's an interior or inside sale. Key employees, same idea. Do you have several or more key employees that are important to the success of the business? And buyers are going to be very interested in that as well. So you may work with a potential buyer or buyers on identifying key people, and there could be added value to the transaction, or perhaps even what we call golden handcuff type arrangements with key people to keep them in place. Compensation during a transition period. So again, if it's not necessarily a full sale one day and then you're out the next, if there's any kind of transition period, how might the owner's compensation evolve from being, again, what's left over the owner gets to some other form of payment? So having those conversations is all very important. Collateral and security can be important, and that's particularly true if you're using the profit or flow of the business post-transaction to actually make the payments to the seller. What can we do to protect the seller? That's an important thing to consider if it's a seller financed transaction. And then, of course, life insurance and disability insurance may play a key role, not only to protect the owners in the event of an untimely death or injury or illness, but it's much easier to obtain when you're younger, healthier, and so forth. You might want to put some insurance policies in place well in advance of any need for them. And then, of course, you're protecting the family of the business owner as well, should an unforeseen catastrophic event occur. All right, so let's jump into some of the income and estate tax issues. I'll tackle the income tax side of things, and Mike will pick up with the estate tax. But I'm going to go out on a limb here and just state the obvious. Sellers want to minimize their income tax liability, right? So most sellers in an ideal situation would love to just sell the stock of their business. That's going to give them capital gains treatment, no risk of ordinary income, depending upon what their basis is. It's just based on the gain from the sale. But unfortunately, not many buyers are necessarily interested in stock. And so we'll talk about that a little bit more. So if it's going to go to an asset sale, then we want to focus on minimizing any ordinary income tax treatment and maximizing capital gains tax treatment. And that becomes very important then in how you allocate the purchase price among the various asset categories. So there's something called recapture, depreciation recapture. If we're selling furniture and equipment, for instance, and we're writing those purchases off over time, that reduces your basis, higher gain, and then that recapture of depreciation comes back as ordinary income on a sale. So again, trying to minimize how we allocate the price. We'd want to explore any tax-free or tax-deferred options that might be available. So I mentioned Section 1202 earlier. If you own a C corporation, and again, this small business stock gains exclusion under Section 1202 only applies to domestic C corporations under various, you have to meet certain conditions in order to qualify for it. One of which is you have to hold the stock a minimum of 5 years, but you could actually exclude up to $10 million worth of gain on the sale of your stock if you meet all the provisions of 1202. Again, not many buyers are looking to buy stock. Those are really unique situations, but if it works and there's an opportunity there, it could be a huge tax saver. If there's any kind of a business combination or consolidation option for you, then maybe there's a delay effect or a deferral effect on your sale, as long as there's no boot or cash coming to you during that merger process. And again, there's very special rules around how that works and how you might qualify to do that. What about installment sales? Depending upon what tax bracket you're in any given year or in the year of sale, you might contemplate structuring an installment component and try and push the tax burden over more than 1 year and just look at tax rates to get the best effective treatment you can. Likewise, there are what we call step transactions. So again, instead of selling the business in its entirety in one transaction, and that even be true with an installment sale, by the way, in a step scenario, you might sell, let's say, 10% of your stock or your membership units over time, 10% a year. And so it's a slower transition. And so you gain a couple of advantages there. One is, just like with installment sales, you're spreading that risk from a tax standpoint over multiple years. But two, it's also a way for you to retain some control. So you're not giving up a majority interest in the business. You're actually kind of phasing out from an ownership standpoint. And so you can stay involved from a control standpoint for a number of years. Now, on the other hand, as we mentioned, buyers, they want to maximize their tax deductions. So again, buying stock is not necessarily a buyer's first choice because they can't write that purchase off. So buyers are going to be most interested in asset acquisitions. And that's why it's so important, when you're negotiating a deal, to look at the buyer's perspective, the seller's perspective. You need to come to some mutually beneficial structure that works for both parties. And there are actually some unique situations where you can get the best of both worlds, and we'll talk about that a little bit later here. Again, asset deals allow the buyer to write off the purchase price over time. If there is a consulting agreement or a severance pay component to the transaction, that's where the buyer is actually paying the seller on a compensation basis over time to assist with the transition. Buyers like that. They can deduct those payments immediately the day they write the check. There's no amortization of goodwill or anything like that. So if there is going to be a seller financed component to the transaction, meaning you're getting paid over time, you really need to put whatever backstops, like we talked earlier, in place, any security or collateral to protect the seller if possible. And it's also good to, again, when we talk about a mutually beneficial structure, if this is going to be a family sale, so maybe one generation selling to the next, the last thing we want to do is encumber the business so heavily with buyout payments that it risks the viability of the business. So again, it's kind of a fine line as to maximizing payout and still having a successful business on the back end of that. Now, there are a few situations where buyers do want to buy stock. And that might be in situations where the business has contracts in place, let's say with vendors for buying products or materials, or customers, long-term service agreements that are in place with customers. And if those contracts are in the name of the corporation, and if they're not assignable, the only way a buyer can really assume those is to buy the stock. And that's those unique situations where buyers actually may want to buy the stock of a business. Another example might be if you have multiple assets that are titled in the corporate name, let's say a fleet of vehicles or hundreds of construction pieces of equipment that have a title. It's very costly and difficult to change those titles. So maybe a buyer just circumvents that and buys the stock. All right, moving on here. Let's now talk about some special issues that are really based on what form of entity your business resides in. So if you're a C corporation, and we've seen, by the way, kind of a resurgence in C corporations since the Tax Cuts and Jobs Act came online in 2018. If you remember, the Trump tax bill lowered corporate tax rates, and so it became popular again to have a C, pay a lower corporate tax if you're looking to do some financing and building by retaining profits. But that's where that 1202 stock scenario comes back into play. So if you got a C and you meet the conditions for 1202, that's awesome. Now, what's not so great with Cs is asset sales, because you have a risk of a double tax. So if a buyer is not interested in a stock purchase of your C corporation and they want to buy the assets from within it, the problem there is you're going to pay tax on the gain on the sale of those assets at the corporate level. And then when you do a distribution of those proceeds to the owner, it comes out as a dividend. You have a secondary layer of tax at the individual level, not a good outcome. So here's where that personal goodwill piece can come in. If you can identify and meet certain conditions that say that the goodwill really resides with the individual business owner, not the business itself, then you can actually bifurcate that asset purchase and have like two separate deals. You're going to buy assets of the corporation and then the goodwill of the owner separately, and you can avoid a potential double tax on that personal goodwill piece. It's great if you can use that. Again, you have to meet certain conditions for being eligible to do that. You should also be aware as a C corporation of something called the accumulated earnings tax. So if you're thinking about retaining profits in cash to do a future redemption of an owner's stock, there is a tax for accumulating too much inside the corporation. It's 20% on profits in excess of 250,000. Now there is a lower threshold for service businesses, and you can actually accumulate more without incurring this tax if you have a plan for why you're retaining profits, but just be aware that that's there. And then liability issues, whether you're an S or a C, if you buy stock as a buyer, you're really just assuming the liability of those businesses. So that's another reason why buyers are typically turned off from stock deals. Now, if you're organized as an S corporation, a couple of unique issues there as well. So S corporations can only have one class of stock. And for the most part, eligible buyers can only be individuals. There's a few rare exceptions to that, but only individuals can buy the stock of an S corp. So it kind of eliminates your field of opportunity when it comes to buyers. With asset deals, then you have to be aware of something called the built-in gains tax. So if your S election is less than 5 years old, and you then engage in the sale of the assets of your business, you will incur what's called a built-in gains tax, and that's effectively treating you as if you were still a C. And you have that double tax effectively because you didn't wait the full 5 years for your S election to fully mature before you sold the assets. Another issue is on a potential mid-year transaction. So if you are able to sell your stock and you do so mid-year, S corporation rules require that profits are allocated on a pro rata basis based on the number of days you own your stock. And so if you have a seasonal business, or if perhaps you had a strong finish to the year, but you sold in June, you're going to get an allocation of profit that may result in phantom income. You're not going to get the cash, but you're going to get tagged with the profit, not a good outcome. So the way to work around that is something called a 1377 election, where you close the books mid-year and you more or less split your tax year into two pieces. The first half that you were the owner, and then the second half that the other ownership group held the stock. LLCs and partnerships, those two have their own set of unique rules. And unlike selling stock in a corporation where it's purely capital gain, if you sell the membership units of your LLC, it's really treated as if you sold the underlying assets of the partnership or the LLC. So it's not always capital gain. There could be what are called hot assets inside that partnership or LLC activity that would result in an allocation of ordinary income on the sale. So examples of hot assets are inventory or accounts receivable if you're selling accounts receivable, depreciable assets, section 1245 and 1250 depreciable assets. So again, that's that recapture component. You have to recognize that ordinary income if you sell the membership units in your LLC. So again, the whole idea here is just create some awareness around some of the different tax treatments depending upon it's a stock or an asset deal and what actually are we selling. So at this point, I'm going to hand off to my esteemed colleague, Mr. Mike Sears here, and he's going to take us through some of the state tax issues.
Great. Thank you, Chris. That was fantastic. A lot to think about there. And we're going to transition now because most of the focus so far has been, as Chris has pointed out, maximizing value for the seller, pushing yourself into lower brackets, into, capital gains brackets versus income tax brackets, the advantageous nature of a stock sale, being clean in nature, taking with it the liabilities, et cetera. And so now we need to think about, okay, well, what if this is really going to stay in the business? Let's focus on intra-family dynamics and issues. And that's a whole nother arena. And so we want to make sure we fold into our discussion today some of those opportunities from a planning perspective and some strategies as well. So I'm going to lead this off just with a basic understanding of the estate tax structure, because that's necessary to know, how to invoke some of these principles and principally when to invoke them and when not to. So fortunately, right now, the federal estate tax exemption equivalent, in other words, the threshold before an individual is subject to federal estate tax, is very high. It's $12,060,000 per person. It was doubled under that Tax Cuts and Jobs Act that Chris had mentioned from its previous rate. And so that's a great opportunity to think, boy, if I want to shift some value here, hopefully as a family unit or an individual, you've got plenty of room. Again, individual, $12 million, a couple, over $24 million. There are some exceptions and some things that we should be aware of. Transfers between spouses. So if you're going to move stock from a husband's trust, for example, to a wife's trust to garner some of the discounts that we're going to talk about, that's fine. That can be done. Not a problem. Those trusts can hold S Corp stock. Those are revocable trusts and grantor trusts. So it's not going to violate any S election. So you can really kind of set the table and work underneath that estate tax code between spouses and then to other individuals. Remember, we have this $16,000 annual exclusion amount that allows us to make small gifts to other individuals. And we can use that as well for the family business. So now what's important is if you look ahead, going forward here, next slide, really you start to appreciate that, boy, this arena that we're in right now, where we don't need to worry about estate tax, may not last. And so I wanted to show the dynamic here going back to 1997, and that the credit has been much lower. So if you think, boy, I'm in pretty good shape right now with respect to my closely held business, I'm not going to worry about estate tax. I'm going to let it sit in my estate and transfer at death. I don't need to do anything strategically. Be careful, because estate taxes are something that is very volatile. It's changed over time. There is the sunset as of December 31st, 2025. It will drop down unless Congress takes other action to, about 6.4 million per person, depending on the inflation adjustment. And it could go lower. I would, point out that the American Families Plan, when it was proposed in the spring by President Biden of 2021, he had proposed a $3.5 million unified credit. And the 99.5% Act and other legislation has proposed a $5 million unified credit. So this is a moving target. If you are if you are above these thresholds, there is a bit of a defense mechanism. It is section 6166 under the tax code. It doesn't allow you to reduce the tax bite on the family business, but if your family business comprises more than 35% of the total value of the estate, then you can defer the estate tax liability over 15 years. You can pay interest only at a preferential rate of 2% for 5 years, and then make payments in years 6 through 15 equal installments. So there is a bit of a relief there in section 6166. But let's talk about one of the big issues that's out there when it comes to transferring a family business during lifetime. And I can't emphasize this enough. And that is basis. And Chris has mentioned it as well. If you make a gift of any property, closely held business, real estate, et cetera, the transferee, the donee, takes the basis of the transferor. So specifically with respect to closely held businesses, often the basis is extremely low. Maybe the business has been in the family for quite some time. Say the value of the family business is maybe $10 million. The basis may be $1 million. just a small fraction of that. If you transfer 10% of that business to a junior family member or an involved family member, they're going to take that basis, $1 million transfer of value, 100,000 basis, and they're going to be embedded with that $900,000 worth of potential capital gain down the line. Now that's different than if the owner of the business continues to keep the property until the time of death, okay? At which point in time, under the current law, there will be a full step up in tax basis to fair market value. So you entirely wipe out that otherwise embedded gain. And why this is important, this comes up in really all strategic estate tax planning, but specifically with closely held businesses, because they tend to have that significant gain. I see situations where people, take action aggressively to avoid a 40% estate tax, and they don't realize that they're going to take on, for certain, a 20% capital gains tax. So you're swapping a 40% rate for a 20% rate. And it can, so the arbitrage, the difference there is maybe not as significant as some people think. And again, if you're not going to be subject to estate tax, or there's a chance that you can do other strategic planning to get yourself below the estate tax threshold, then you're just out the 20% in the loss of step up in basis. Now that would be bad enough if the capital gains rate stayed at 20%. But as Chris knows, and he and I have lectured in the past and done webinars, it wasn't that long ago, the American Families Plan, where they were pushing to increase the highest marginal capital gains rate to be equivalent to the highest income tax rate. And so with the net investment income tax on top of it, it would push the, under the 2021 proposal, it would have pushed the capital gains tax rate, the highest rate, to 43.4%. So even higher than the flat federal 40% estate tax right now. So an inversion of the tax rates. Now that did not make it into the proposed Build Back Better legislation later last fall, which didn't pass, but there was a proposal to increase capital gains rate to 25%. And I think this is important to be aware of in this new normal. Part of this program is to plan ahead. Just like estate tax thresholds are a moving target, so are those capital gains tax rates. We saw a lot of clients divest themselves in anticipation of that. The question becomes, for those that did that, did they do that too quickly or not? The time will tell. I think that when you look at the deficit as a practitioner of the US Treasury and our propensity for spending, there needs to come some additional revenue to the US Treasury. Only about 17 to 20 billion comes from estate tax as part of that 3.7 trillion spendings, a revenue source in total tax revenue. So I think capital gains tax and changes there become something that we definitely need to keep our eye on going forward. Okay, so watch for transferred basis. Now, when it comes to these intrafamily transfers, there are a number of tools that practitioners have at their disposal. So you can basically double your estate tax equivalent as you have it right now. So think about the federal estate tax credit. Let's assume it's the 6.4, 6.5 million that it's going to be on January 1, 2026, and that law stays in place unchanged. If you're transferring to the next generation, a closely held business, you're going to attain a marketability discount. That's a discount for the fact that the entity is not liquid, it's not traded publicly, and so there's an embedded discount off of fair market value on any transfer that you can apply on the gift tax return. In addition to that, if you transfer a small, less than a controlling interest, you'll get an additional minority interest discount, again of 20 to 30%. So if you combine those two discounts, you're looking conservatively at 40 to 60%, which allows you to essentially balloon that estate tax credit when using closely held business interests as a possible gifting tool. And so that you have to weigh that in relation to the other estate tax avoidance planning that you're doing. Does it make sense to transfer the closely held business using these discounts? How do we do that? The loss of step up in basis, or maybe should we hang on to the business, get a step up in basis and maybe use other assets from an estate tax avoidance planning. And I list a few of the techniques here. Now, we don't have a full 5 hours today to go over our business succession, but certainly we're available and we can do this in the future. A couple of the tools: intentionally defective grantor trusts. You see the acronyms there: IDGTS, IDGTS, or GRATS, grantor retained annuity trusts, or SLATs, spousal lifetime access trust. These are all irrevocable trusts. They're tools that allow us to freeze the value. Okay, what that means is you can transfer those business interests out of your estate at a lower value and remove all of the appreciation from your estate. You can do it with these discounts in place. Okay, but again, remember, it will be with a transferred basis, so you have to be careful. And in the case of the IDGTs and the GRATs, you can actually also gain an arbitrage between low interest rates on, for example, a promissory note on the IDGT, or in the GRAT context, it's an annuity back to the grantor. So you actually get a kind of a trifecta benefit here. You get the discounts, you get the freezing technique, and then you get the interest rate arbitrage, which really often can more than make up for the fact that you're transferring low basis assets and going to have a gain later on, especially if the gain is, maybe perhaps going to be long into the future. But it's something, to consider in our quiver as we think about transferring that family business. So those are some of the techniques and available items that we often work with our clients to make sure not only are we dialing in if it's an exterior sale to a third party, some of the things that Chris talked about, but also if it's a related party, an intrafamily transfer. Chris did mention voting trusts. Again, if you have C Corp stock, you might create voting and non-voting classes of stock and transfer the non-voting interests. You might look at the possibility of some type of voting trust, or if you have a limited partnership, transfer limited partnership interests and maintain the general partnership or controlling interests. So there are a number of ways to maintain family control. In this regard, I would also say it's important, if you're going to transfer to a next generation, it be in trust with a stock restriction and purchase agreement in place in case there's a dissolution of marriage downstream, or make sure you don't want it to become marital property inappropriately, something along those lines, or those sort of asset protection measures are in place. And then a big issue with respect to the intrafamily side is if you're taking these discounts, and again, if you're in a taxable estate, you should be moving these business interests using these freezing techniques and discounts appropriately. You're going to end up shifting significant value to one or two members of the family at a very discounted rate in relation to the others. And that can cause some disharmony in the overall estate plan, hard to settle. It can be done through some equalization provisions at the time the succession plan is put in place. Equal is different, certainly, to different members of the family. But I find that if you at least address it in the estate plan clearly, that you communicate it, the fact that it may have different definitions among family members, at least it's clear. There's not an opportunity or a propensity towards litigation on that front, and it can really go a long way. So you don't want to lose sight of the things that you can do, from that perspective, or need to do in the family succession plan. And then the last thing I list here is grandchildren's trust. If you're making family transfers in front of an ultimate sale to a third party, you might consider moving, small blocks of interest to irrevocable trusts for grandchildren, with the idea that these would be, leveraging of moving value outside of a child's estate to the next generation. So you're going to be using generation skipping exemption. Those resources will be available then for education of those grandchildren, or first-time home purchases, or future business startups. And if you get in front of the liquidation event, upon liquidation, you can have a nice little sort of nest egg there for that next generation for those purposes. Again, You would want to use trusts to protect it from an asset protection standpoint and control, perhaps have a child, the parent of the grandchild as trustee, maybe implement some trust protector provisions. So there's flexibility to change tax situs, depending on what state the grandchild is residing or domiciled in, to save some income taxes. So again, looking through the family succession plan, all the way down to the next generation. The last thing before I hand it back to Chris here, and he's going to kind of talk about maximizing the payout a little bit, is with respect to a caveat and a concern. If you do maintain the assets in the estate, or maybe you start a smaller percentage family transfer plan and retain 78% of those assets, and you're going to put in place a buy-sell arrangement, make sure the agreement is going to be recognized and upheld by the service in an examination. If you think it might be possible, you'll have a taxable estate and that estate tax examination. And the reason is that if you don't abide by 2703 and follow these 5 requirements, the service isn't required to uphold your valuation in your buy-sell agreement. They can recast that value for purposes of estate tax to whatever they think is appropriate. And they're going to want to do that. They're going to want to have it, unlike you, as high as possible, because it could be more estate tax. And if they do that, then the tax bill goes up and it goes to the residue of the estate, which means the beneficiaries generally are going to be subject to that tax. And now you have perhaps a situation where 1 or 2 children are receiving, an asset at a very discounted rate, and the others are having to pay the freight for that transfer, and that's a recipe for disaster. So I'm not going to read through the requirements in the interest of time here, but 2703 and these 5 requirements should be something that you should pay attention to. Okay, so that's a little bit from a intra-family perspective. Let's switch gears and talk a little bit. Chris, I'll pass it back to you on maximizing payout.
Thanks, Mike. And so again, kind of thinking back now to scenarios where it may not be a transfer on the back end, but more of a lifetime transfer or sale. What can we do to try and ensure that you maximize your potential payout? Well, again, first and foremost, are your documents all up to date? So have you looked at those shareholders agreements, operating agreements, employment agreements in recent years? We see way too many examples of documents being drafted and then they sit on a shelf for years and years and they're never revisited. And there could be provisions in there that are contrary to what you're looking to execute on a structured basis currently based on current tax law or just current objectives. So take a look at those documents, dust them off more than occasionally, and just make sure they're up to date. Also, again, tax rates and tax bracket awareness is critical. So again, if you've got a situation where you have a high value business and you're in the highest tax rates, what other deferral mechanisms could you possibly put in place to spread that out a little bit and hopefully stay in some lower brackets? Again, back to capital gain versus ordinary, maximize capital gain tax treatment, minimize ordinary tax treatment. Having the knowledge of pending legislation, we've mentioned this 2 or 3 times with recent experience, the American Families Plan, Build Back Better Act, all contained basically proposals that would significantly raise tax rates. And so if you know that this is on the horizon and it's still an evolving situation, tax legislation wise, just kind of having knowledge of what's out there might help you with your timeline. So do you try and close a deal before any new legislation comes in? And just continuing on, again, kind of starting where we are, kind of revisiting where we started, where sellers are looking to hopefully maximize capital gains treatment, and understanding buyers have a different objective altogether. They're looking to buy assets. So in most transactions we see during lifetime, it's actually going to be an asset deal. And Buyers and sellers have to then allocate the purchase price among the asset categories. So I mentioned this earlier. There's actually something called the uniform allocation rules. And there's actually a form that the buyers and the sellers each have to attach to their tax return that says, so much of the price is furniture and equipment, so much is goodwill, so much is accounts receivable. We have to identify those buckets. And the reason you have to do that is that, you know, if you're kind of left to your own devices, the sellers are going to allocate it one way and the buyers are going to allocate it another, and the IRS isn't going to like that. So what we see all too often is that allocation isn't baked or settled prior to closing, and you kind of retrofit it. And back to recipes for disaster, that's another one, you know, where the parties didn't really think through how to allocate the price, and you could avoid that heartburn if you just agree to the allocation prior to closing. Again, understanding ordinary versus long-term capital gains treatment and really what generates ordinary income, so that recapture of depreciation on any assets that you've been writing off over time, understanding how that works. If you're looking to use cash flow of the business to transfer value, we call it foregone services. So severance payments, consulting agreements, things like that. Buyers love that because they're paying the seller out of cash flow. They get an immediate tax deduction, but that's all ordinary income to the seller. So you want to try and minimize the use of those techniques if you're the seller. Going back to goodwill, I talked earlier about enterprise goodwill versus personal goodwill. There's another wrinkle when it comes to goodwill. You could actually have either purchased goodwill, where you maybe bought a business earlier on that had a goodwill component to it, and then also maybe self-created some goodwill, or no purchased goodwill. It was all self-created. Well, if your business does have any purchased goodwill on its balance sheet, you have been writing that off as well. And so on the sale of the goodwill component on your back end, that recaptures back as ordinary income too, because that write-off of the goodwill is offsetting ordinary income as a deduction year over year. So just be knowledgeable of that. And then again, this could drive the negotiation on how much are you trying to get. Again, it's all about what you keep, not what you sell it for. So knowing these tax attributes is very important to maximizing your net in your pocket after taxes. There's also something called the deemed asset sale. So, basically, we've talked about how buyers typically don't want to buy stock. It's those rare situations where, contracts in place, multiple titled assets that can be difficult to change. There is a tool and a technique whereby a buyer can do a purchase of stock and get the benefits that go along with it, but then treat that purchase as an asset purchase for tax deductibility purposes, and it's under Code Section 338. And again, this is really just a tool and a technique that helps the buyer out. And you may say, well, why do that? Well, again, if it helps you close a deal, why not use that? Now, both sides have to agree to making this election. And typically, because for the seller, that reintroduces this idea of recapture and ordinary income, that may then require a sweetening of the pot on the purchase side. So again, it's how you negotiate the ultimate value. If you're giving a little bit by agreeing to a 338 election for the buyer so they can get these contractual rights, you should get more money as a result of that, because you're going to get dinged a little bit more on the tax side. And then, of course, the best thing going, 1202 stock. If you've got a C corporation and you meet the conditions under 1202 and you can find a buyer for that stock, best thing going, tax-free up to 10 million. So that would be ideal. And so Mike's going to now follow up with some post-closing considerations.
Thanks, Chris. Okay, so we've come to the near the end here. So you finally put together the sale of the business, and one of the things that you're going to think about is, oh my goodness, what do I do with all this? I have all this taxation. And there are a number of techniques out there, of course, that you can do to offset the tax bill that you have that might fit in to your overall estate plan. And one simple one that we listed here is as a use of a donor advised fund. So you might front end significantly in a year of a sale, a transaction, a significant contribution to a donor advised fund, obtain an income tax deduction upfront, and then you don't need to make those contributions in future use. You make them out of the donor advised fund. So essentially bunching of your charitable contributions to offset some of that taxation. In that same light, I would put the funding of a grantor charitable leave trust. Now, this would be something that could be significant. You could make for example, $1 million gift to a charitable leave trust, paying a 5% interest to charity for 20 years. If you didn't survive the 20-year term, your family members could be responsible for getting together, deciding which charity or charities will receive that $50,000 annuity. And what has the advantage of is getting a significant income tax deduction in year one. It's entirely front-end loaded to wash against the taxation of the sale. And again, you can do it perhaps in a larger amount as well. And then the remainder interest to the children, the gift tax consequence after the 15 or 20 years is very small in relation to the overall contribution amount. So if you contribute maybe $1 million, you might have a $200,000 gift to children. So you've leveraged that estate tax code again, in addition to getting an income tax deduction. And so it can be a great device, often paired in the year of sale to offset that tax deduction and have an estate tax benefit down the line. Many clients also like this device because in the estate plan, it gives sort of a boot consideration to family members, and it could be grandchildren again, 20 years down the line post-mortem. So instead of everything being up front in a year of death, there's a certain amount with, almost a retirement piece coming, 15, 20 plus years later. So interesting device there as well. Of course, you have your overall charitable deductions. Now, we often, the best approach in business succession planning, you can fund these, during, lifetime with closely held stock ahead of the transaction. You wouldn't be able to then transfer, there would be a private annulment or benefit principle that would prohibit a repurchase by yourself. But if there was a third-party sale, you could get in front of that and establish some of these devices before the third-party sale, which again would be, a home run with respect to estate taxes, avoidance of capital gains tax, and perhaps some wealth shifting to other generations. The trick there is that there's a doctrine called anticipatory assignment of income. You can't wait until you have a letter of intent or you've negotiated the sale of a closely held business and then fund these types of devices. The IRS is onto that, and they'll say, no, the capital gain is already recognized and you won't get those benefits. So, but you can get in front of the transaction to do it, or as I said, you can do it after the fact, but use other assets, use liquid assets. So you're essentially looking at the estate to create the right mix there together. Of course, post-closing matters. You're going to think about the estate plan. Does it necessitate changes? This is something I would hope everybody would be doing on a fairly routine basis, being a practitioner, to make sure something's not overlooked. We see this often. There may be life insurance programs in place. Maybe it was purchased a long time ago. You're still making premium payments on it. You don't need the liquidity any longer. The event is over. The estate tax rates threshold is so high, you don't need the insurance program any longer to pay the otherwise planned estate tax liability. So, you want to look at those life insurance programs. You might flip a policy, do a like-kind exchange to a paid-up policy requiring no premiums. Again, sort of recast the estate plan, more beneficial. Then you've got annual exclusion gifts, again, restored, and you can use those for other gifts to other family members. So again, sort of redialing in elements of the estate plan that you don't need any longer. Certainly, at the close of a business, you're in a different situation, different expense habits, different set of assets. It's no longer this closely held business where we don't know the value. We've got a pretty defined dollar amount. rerun retirement projections. You look at things from a long-term perspective, what you might be able to afford to gift, to be able to use for other generations. So routinely, the beauty of our institution is people, on the tax side, Chris, the estate side, myself, and Stephanie, on the financial planning side, working together as a team to make sure everything is in the same, considering the same set of factors and circumstances, and making sure that we're not missing anything at all on legal, tax, or financial planning fronts. And then again, we would always recommend estate tax projections, post liquidity. Are there other devices? Because it's never over. We have to always be considering, again, the sunset provisions in the Tax Cuts and Jobs Act, potential changes brought about by the American Families Plan or Build Back Better. What do we need to do, to reassess on an ongoing basis? So I know that was a lot for everybody today. There's never an easy jumping off point when it comes to these types of matters. Hopefully, we've given everybody some good things to think about. We've got some really good questions that have come in. So I'm going to take the first two here. Take the easiest one first. I see somebody's asked about making sure that the stock certificate, should it be retitled to a trust, or is that problematic depending on the stock restriction and purchase agreement? Membership certificates in LLCs, stock certificates should always be titled to the revocable trust of a husband or wife. And the reason being, if not, in a postmortem context, then a potential buyer might wonder whether or not they have authority to implement an officer or director structure for an entity if it's a corporation, to sell those assets, to sell that stock. And it would require potentially a probate proceeding, which could be monitored depending on the type of probate in the state by a court, really slowing things down, causing a fair amount of additional expense that's unnecessary. Again, if those interests are held by trusts, the IRS ignores those if they're revocable grantor trusts. So there's no harm whatsoever, and there's all upside. It's probably one of the most common errors that I see in estate planning is people will create a LLC. It could be for a business, could be for a piece of real estate, a single member LLC. They don't have a membership certificate that goes with the creation of that entity. They don't know where their stock records are. Their stock records are not titled appropriately to a trust. And so a great question. I appreciate that being brought up. And again, in a husband and wife context, if that applies to you, good idea to have half the stock titled to each trust, because you're going to be able to avail yourself of those, potentially of those discounts as well. If 100% of it is in the name of a decedent and you have a taxable estate, you're not going to get that 20 to 30% minority discount that we were kind of hoping for. And then the second question I see popped up, can a closely held stock be transferred to a charitable lead trust prior to sale? It can, again, as I said, but if you're just going to reacquire it in a redemption proceeding, you can't move it into the charitable lead trust and then a related party, because the charitable lead trust is a private family foundation for tax purposes. That would be prohibitive. But certainly ahead of a third party sale, that would work extremely well. So they're still popping in here.
I'll grab one real quick too. So one came in regarding the net investment income tax. So is the gain on the sale of a business subject to the net investment income tax? And if you recall, that tax came in with the Affordable Care Act. It was one of the Medicare supplemental revenue generators. It's that 3.8% surtax on investment income with and the answer is no. The good news is no. So if the sale of an asset used in a business creates a gain, there's no NIT tax on the sale of that asset. And that even applies to the stock. If you sell the stock in a business that you actively participated in, at a material participation in the business, no net investment income tax on the sale.
I see a question here. I'll take this one regarding the proposal last spring in the loss of step up in basis. Was there a credit amount that you could apply to step up basis of assets? And there was. I mean, it's been a moving target. It was as last proposed $1 million. So there would be, under that proposal, there would be no step up in basis at death if that law were enacted, but you would be given $1 million credit, kind of like the estate tax credit, but a credit against capital gains tax. You'd be able to step up assets and spray that credit around up to $1 million per person. So a little bit of relief there. And I really think that's an important point to bring up. There was a study that was done with respect to taxable estates, and it indicated that as just under 50%, 44% of taxable estates have significant embedded capital gains. So you can see where if you were going to have a revenue raising, change to any tax structure, then certainly you can hit a broad spectrum of individuals and raise a lot of tax if you kind of do away with the capital gains step up at death, but for this adjustment credit. And so that's something to keep an eye on, especially again, if they were to raise those capital gains rates from 20 on the high end, from 20 to 25 to, personal income rates or otherwise. I think that's, something to keep in mind. Another question out here on, setting up a family office for closely held businesses. Appreciate that as well. Is it a good idea to do in advance? And I would say absolutely to do in advance. Family office structure, there's a lot of dynamics when you have a closely held business. You might be setting up a family foundation. The business of the family may transition from employing individuals in a community to supporting that community through charitable endeavors. So there's going to be filing requirements, et cetera, for that family foundation. It might have registration requirements under a not-for-profit corporation act or a charitable trust act. Of course, there's the different family dynamic. There's the tax consequences, possible filings with Attorney General's office, et cetera. And I think, the nice thing about a family office, when you bring all of the professionals together, they're watching out for the legal issues, the tax issues, the investment issues of the family, and the whole structure kind of works together. So great question on that. So I think we're about out of time. So I think I'll hold off on some of these other questions that we have here.
Yes, Mike and Chris, thank you for all the wonderful information. Participants, thank you for participating in today's webinar.